Joining me now, Goldman Sachs Head of Oil Research, Daan, and of course, Alger Executive Vice President, Ankur Crawford. Thank you both for being here with me. Daan, let me start with you. You hear this headline risk, the geopolitical risk. How does that change your world of commodities?
Thanks, Taylor, for having us. I think the elevated geopolitical uncertainty and today's headlines illustrate the hedging value of commodities in portfolios. Okay. Hedging value against upside risk to inflation and hedging value against portfolio risk. While our base case for oil prices is that they remain range bound next year, we do see some upside risk to prices in the near term for potentially lower supply, in particular from the Middle East.
How do you invest sort of long term within your world of U.S. equities? Do you stay invested through headline risk, or on the margin, can you tactically make some changes?
I think depending on the changes, obviously reacting to a war and what's happening overnight is impossible for a long-term portfolio. But there are larger thematics in the portfolios that are kind of evergreen regardless of the geopolitical situation. So you have to decide what portion of your portfolio is tagged to kind of a non-economically sensitive, non-geopolitical aspect versus not.
Daan, you mentioned something interesting, that you expect oil prices to remain relatively unchanged next year. Do you not expect comments from President-elect Donald Trump of drill, baby, drill to not bring down oil prices?
So we do think that potential regulatory easing for the oil sector may significantly boost oil production several years down the road. Okay. But oil prices are a spot asset. They tend to price fundamentals over the next few quarters. And we do think that the drivers of U.S. oil production in the short term are oil prices, technology, and shareholder discipline and shareholder goals from shareholders. And so we think that the impact on oil production from any regulatory easing on the U.S. oil sector side may be significant over the long term, but pretty limited in the short term. And so we do think the impact is somewhat limited. We do think that the two areas where the new president and the new administration may impact oil prices could be on the positive side for prices, a tighter enforcement of secondary sanctions on Iran, where supply has risen by 1 million barrels per day. That's 1% of the global oil market over the last 2 years. And then potentially on the negative side, it's not our base case. In our base case, the U.S. economy continues to grow at a healthy pace. But if you were to see a broader-based imposition of tariffs on all trade partners, that could weigh on global GDP, that could weigh on oil demand, and therefore prices. Those are really the two areas that we're the most focused on: sanctions in Iran and tariffs.
And some of those sound inflationary. Ankur, do you agree with that assessment? And if so, if I'm sitting at home and I'm looking at my equity portfolio, do I invest around what could be a sort of this big reflationary trade, or am I confident that we've beaten the fight on inflation and I can invest around that?
Yeah, I think we have to be very careful on inflation, and a lot of the Trump policies are in fact inflationary. And one of the things that can take the exuberance out of this current market, I believe, is both the 10-year and inflation, which are inextricably linked.
The 10-year Treasury since Trump got elected has been rising. Now today, of course, yields are lower just a little bit, but in general, yields are rising. What point is it 5% on a 10-year where I now start to see equities under pressure?
I think it's about 5%. I think that's about the whisper in the market as 5% starts to take things apart.
Both of you guys came with hot ideas. I'm desperate to get to them. Daan, you said that you have a great call on gold. Walk me through, because I've been watching Costco sell gold bars. I'm desperate for a gold bar. Everyone, I think, is so excited when you see record after record. Why is gold on a tear?
So we expect that gold will rise an additional 15% to $3,000 per troy ounce by the end of 2025, on the back of two really positive demand forces. On the structural side, since mid-2022, when Russia's central bank's assets got frozen in the context of sanctions, you have seen a five-fold increase in gold purchases by emerging central banks.
Interesting.
And we think that's a structural increase in demand that's here to stay, with a lot of room for additional purchases. And then on the cyclical side, our base case is that the federal funds rate declines to 3.25% to 3.5% next year. And that makes gold, which is a non-yielding asset, more attractive. And so you get support on the demand side, both from rate cuts from the Fed and on the structural side, where central banks are going to continue to purchase.
Why gold and not Bitcoin?
I don't think that central banks are currently purchasing Bitcoins globally to a significant extent. And I think the reason is that gold has this very long history, going back centuries, actually millennia, of being a real asset that preserves its value. And that, I think, gives the confidence to central bankers to go for gold when they diversify their reserves.
Ankur, you came, you sat down in your chair, and you said we have to talk about AI. There's lots of sort of adjectives that we can use. Someone says we're in the first inning. Other people say it's 10 p.m. and the party goes till 4 a.m. Whatever adjective we use to describe it, where are we in this AI revolution as we await NVIDIA in about 24 hours?
Yeah, early.
Really?
Right. I don't know what inning it is, but it's pretty early. And the great thing about AI, it's the mother of all cycles right now that we have seen in our careers. Like, it is bigger than any singular cycle that we have experienced thus far. And it still hasn't expressed itself. If you look at the valuations, like NVIDIA today trades at a 20 multiple on our 26 numbers. That's not that egregious, so we're nowhere near bubble territory. And so, you know, AI is our future. It's not geopolitically sensitive. It is not economically sensitive. And the train has started to move, and there's no stopping it.
You mentioned NVIDIA. I think a lot of people at home are wondering if they missed the NVIDIA train or not, and I think you've argued maybe we have not. Are there first or second derivative AI plays where I get exposure to AI that isn't AI directly in the name of a chip?
Oh, sure. There's a multitude of different companies that you can invest in that are scattered actually throughout the economy, whether it's companies like Vertiv that just had an analyst day yesterday. They make cooling systems for data centers. There's the nuclear energy plays, you know, Constellation Energy, Talon, and then uranium in order to support those nuclear energy plays. So, I mean, you can even look at companies like AppLovin that are deploying AI inside of their businesses, and it's incredibly accretive to their business model. And you look at the stock, it's gone from 70 to 300.
And we're starting to see it play out in real earnings.
And you're starting to see it play out in real earnings. And so there are a multitude of different ways to express an AI bullish view. But it may take a little bit of creativity since a lot of them have already been uncovered.
Well, we really appreciate both of you being here. Daan Struyven and Ankur Crawford, thank you both so much. I really appreciate it.